guess I was a little confused on what the big differences between the perpetual and periodic inventory system in regards to.
This week, we're going to cover Chapter 7 in our Cengage textbook, and we're going to talk about internal controls. Primarily, the exercises in this week are going to deal with preparing bank reconciliations and talking about petty cash. So, there were huge, sweeping changes at the beginning of the 2000s, like 2003, because many companies were being caught. Not that it hadn't happened, but they were being exposed to corruption and fraud. Some of the big ones, WorldCom, Enron, those are the two really big ones. But basically, there was a lot of fraud that was perpetuated at the top. The managers, the executives were harming companies. As a result of that, Congress needed to do something because people are investing in the stock market, and the public needs to trust that their financial statements are correct when in fact they were really bad. And that was part of the problem. Is the big CPA firm Arthur Andersen was a part of all the fraud also. So two men in the Senate came out with all these guidelines to try to force corporations, public companies, to be held to a higher standard. So the Sarbanes-Oxley Act, sometimes we call it the SOX Act, only applies to companies that are traded on the stock exchange. And really what they were trying to do is create guidelines regarding the internal controls of a company and make management sign off on them to make the higher management personally responsible that they were adhering to certain internal controls. There was all this fraud. They enacted Sarbanes-Oxley Act. After the passage, there's still fraud. Let's not lie. But it's just another deterrent, another safeguard that was put into place to try and hold public companies to a higher standard. So what happens now is these public companies need to report or need to sign off on the internal controls. And the auditors now that audit a company have to provide an opinion regarding the internal controls in place. So here you see eBay. Our management is responsible for establishing and maintaining adequate internal controls over financial reporting. Our management conducted an evaluation of the effectiveness of our internal controls based on the framework, blah, blah, blah. Based on our evaluation under the framework, our management concluded that our internal controls over financial reporting was effective. Again, the purpose was to hold those people who are running the company accountable. So many times, companies go down and management plays stupid, like, oh, we had no clue that was happening. Well, you better know. And if you don't know, you're going to be held accountable to it. So internal controls are important because they protect the assets of a company. As you see here, internal controls safeguard assets by preventing theft, fraud, misuse, or misplacement. A serious concern of internal control is preventing employee fraud. Employee fraud is the intentional act of deceiving an employer for personal gain. Now, I'm going to stop this 1 minute and share a story, and then I'll put it. So as we move on here, why do companies need internal controls? They want to make sure assets are safeguarded, protected, secure. Internal controls are important because we want our financial statements to accurately present what's really going on. And we need internal controls in place. So therefore, when we show we're depositing a certain amount in the bank account, that in fact is what's happening. It allows us to provide clean information. And we need to obey the laws of the country. So there are various risks that come into play that can harm, that theft can occur or fraud may happen. There is something we call a control environment. There's a risk assessment. We need procedures in place. And ultimately, even though you have all that up and running, you still need to monitor to make sure it's really working. So, in regards to internal control, we need, based on the type of company we're dealing with, we need to have procedures in place. Let's just think of a casino. Given just the mere dynamic of the cash that flows through a casino, do you see there are risks in place just because of the nature of what the company is? Does that make sense? Or I was just flying home on an airplane. You used to be able to purchase items with cash on an airplane. Now they don't allow you to do that anymore, do they? You have to use a debit card or a credit card. Why do you think that is? They're trying to eliminate the ability for cash to just walk away. Does that make sense? So, the control environment consists of the whole structure of a company. It consists of the management, who's running the show, what's their culture like, the employees, the policies, and ultimately management's operating style. All businesses have risks associated with them. Management needs to look at that particular company, identify the risks, see how significant they are to the running of a company, and take actions to minimize those risks. So, such as make sure there's competent people on hand, rotating duties, mandatory vacations, separating responsibilities for related operations, separating operations, custody of assets, and accounting, having security measures. You need to have competent employees. Yes?
How would mandatory vacations?
Okay, good question. So there are scenarios where, let's say one person's doing all the deposits. When you have, and maybe even opening the mail. When you have a mandatory vacation, that employee is removed. So other things can maybe be exposed. Okay? I'd love to spend 10 minutes showing you a video. This guy audits various companies and the stories that happen with the fraud that take place, just because sometimes it's a smaller setup and someone's the one opening the mail, making the deposits, and the way in which he makes the deposits, he takes money out for himself. So oftentimes when you're required to have mandatory vacations, because they're not part of the system anymore, fraud can get exposed. Okay. Separating responsibilities is a huge piece of controls. The responsibility for related operations should be divided among 2 or more people. If the same person orders supplies, verifies the receipt of the supplies, and pays the supplier, here's what could happen. Orders may be placed on the basis of friendship with the supplier rather than on price, quantity, and other objective factors. The quantity and quality of supplies may not be verified. Supplies may be stolen by the employee. The validity and accuracy of invoices may not be verified, so the company may possibly pay something false or inaccurate. I once went to a continuing education course, and the person who was conducting this course was hired by the Mayo Clinic to be an outside auditor. And he told one person in the company at the Mayo what he was doing, but he didn't tell anyone else. What he started doing was he just started creating fake companies and sending invoices to different parts in the Mayo. And if they wouldn't pay, then he'd get aggressive and like, you haven't paid this bill in 30 days, pay it. And I think out of, don't quote me on this, but roughly 30 of the ones he did, everybody but 2 paid him. And they were all lies. So in other words, they had a vendor list of who they were supposed to use as outside vendors. He created people that weren't even on the vendor list. You know, he set it all up just to see what would happen. And there were only 2 people who verified that they paid it. They didn't even really provide the service or get the supplies. And what does that speak of? Such poor controls in place. They just paid stuff without ever having backup. Am I making sense? And so as a result of all this, I mean, it really exposed how weak their control systems were. People were just paying stuff. They wanted them off their back. So it's really important to make sure that you have backup, but that the person who orders supplies isn't necessarily the person who checks them in to make sure they're right, who pays the bills. I know I worked for a company back in the 80s, and they would buy the file folders, and what happened is if they bought so many thousands of file folders, he got a free Rolex watch. Well, no one else needed to know about the Rolex watch. Do you get what I'm kind of saying? It just got put into the 50,000 file folders. So some of that you can't always avoid, but he shouldn't have been the one ordering the supplies, the one paying the bill, blah, blah, blah. The responsibilities for operations, the custody of assets, and accounting of the transactions should all be separated. In this way, the accounting records serve as an independent check on the operating managers and the employees who have custody of assets. Proofs and security measures are used to safeguard assets and ensure reliable accounting data, and there should be separation. Whoever authorizes various transactions should have someone who approves them and then someone else who reconciles them. And ultimately, even after all of this is set up, they should monitor that the internal controls that they've put in place are actually working as they have wanted them to be working. What are some warning signs that there could be problems? In relation to people, abrupt change in lifestyle without winning the lottery, close social relationships with suppliers, refusing to take a vacation, frequent borrowing from other employees, excessive use of alcohol or drugs. And for the warning accounting system, missing documents or gaps in transactions, increases in all these customer refunds, or they may be customer refunds or someone else getting the refunds. Differences between daily cash and bank deposits, sudden increase in slow payments, backlog in recording transactions. So things need to be operating effectively. Every once in a while, there can be a blip in the system, but if there are continual issues, they need to be looked at. Internal controls work when there is structure, communication in place within a company. Management uses external information to assess events and conditions that impact decision-making and external reporting. Now, guys, all of this is good, but truly, if someone wants to steal, they're going to find a way to steal. Internal controls aren't a guarantee because the human element can screw it up. For example, say you're buddies with the person who receives the product. There's something called collusion when 2 or more people come together to try to defraud a company. It makes it harder to catch that because people are in cahoots. The other thing that can be a negative is upper management. Upper management can override the controls. Okay? So even though these are great and there's a purpose for them to be in place, still things can go wrong. Guys, which of the following would least likely be a warning sign of an internal control problem? An employee refusing to take a vacation, missing documents. An accounting employee working a lot of overtime at year end would not be, because guys, guess what? You do work a lot of overtime at year end just to get the books going. Good thing. So there are certain controls that one can have in place in terms of cash. Cash includes, for our purposes, currency, checks, and money orders. Money on deposit with a bank or other financial institution is also cash. You think of cash as anything that a bank would accept for deposit into your account. To protect cash from being able to walk away, it's got to be controlled. Usually, businesses get cash because of customers purchasing products or services and customers making payments on account. So one way to have a control in place is cash that comes in through a cash register. There's got to be some type of safeguard with monitoring that cash. Salespeople can make errors in making change for customers. The amount of cash on hand can sometimes differ from cash sales. There can be shortages or overages. So assume the following cash register data for May 3rd. We show the cash register shows a total of $35,690. But the cash that came in shows $35,668. So, I mean, this is going to happen, especially when you get busy and you're dealing with cash and you got someone behind you, wanting to get out the store. This stuff kind of happens. Now, cash register as a control. Sorry here, I want to go back. How do I get back? Oh, there. You see, here's a simple example of a customer's in a grocery store. The customer is going to check out. The customer gives them cash and the possibly gets refunds. After the end of the day, this all goes to the accounting department where they make a ticket, a deposit slip, which ultimately goes into the bank. The accounting department controls the paper flow, but someone else is going to take and handle the actual cash. So these two procedures are handled separately. Okay? So whoever goes, counts the cash, and takes it to the bank is going to be a separate entity, separate department than the accounting department that's reconciling. Okay? The sales, receipts, and shortage of $22 would be journalized as a debit to cash for $35,668, a debit to cash over and under or short and over for $22, and we'd credit our sales for $35,690. Cash can be received in the mail when customers pay their bills. This cash is usually in the form of money orders or checks. Most companies design their invoices so that customers return a portion of the invoice, called a remittance advice, when they pay their bill. Now, guys, so much of this is done electronically nowadays, isn't it? Cash can be received through electronic funds. Companies encourage customers to use electronic funds because it costs less than receiving cash through the mail. They are a positive enhancement in terms of internal controls, since cash is removed from the whole equation. And electronic funds can help reduce late payments from customers and speed up the processing. They get their cash faster. In terms of cash payments, payments should only be made for transactions that are truly happened. Yes.
With EFTs, how do they get their cash faster than just getting cash?
Because instead of it going through the mail, instead of it having to be delivered, it just, happens instantly. Well, within a day. Does that make sense? In a small business, an owner-manager can authorize payments based on personal knowledge, but a large business, things are different. Purchasing goods, inspecting the goods received, and verifying the invoices need to all be performed by different individuals within the company. Voucher systems are procedures that are used for authorizing and recording cash payments. A voucher is any document that serves as proof of authority to pay cash or issue an electronic funds transfer. An invoice that has been approved for payment could be considered a voucher. In many businesses, a voucher is a special form used to record data about a liability and the details of its payment. In a manual system, a voucher is normally prepared after all necessary supporting documents have been received behind it. In a computerized system, data from the supporting documents can be entered directly into the computer files. So it's ultimately the same system, we just have it done on an electronic basis. Cash, when it's paid by electronic fund systems, so guys, not many people write checks anymore. A lot of my clients that are in their 20s and 30s don't even know what a check looks like because they just don't even have them, because everything can be done electronically. Guys, a voucher system is often used to verify that supporting documents have been collected prior to the payment of invoices. Which of the following would not be one of the documents needed to complete a voucher? Anyone? C, company checkbook. Looks good. Correct. Now let's look at some examples of good internal controls and bad internal controls. Faith Casson has recently been hired as the manager of Gibraltar Coffee Shop. Gibraltar Coffee Shop is a national chain of franchise coffee shops. During her first month as store manager, Faith encountered the following internal control situations. Faith caught an employee putting a case of 1,000 single-serving tea bags in his car. Warning! Not wanting to create a scene, Faith smiled and said, "I don't think you're putting those tea bags on the right shelf. Don't they belong inside the coffee shop?" The employee returned the tea bags to the stock room. State whether you agree or disagree with Faith's method of handling that situation. What do you guys think? Disagree? What would you have done different?
Tell management so it doesn't happen again.
Well, she is the manager.
No. Oh.
Fire.
Yeah.
You know? I mean, come on. I'm sorry. I don't think you're putting them in the right storeroom. Wake up. You know, what's it take to be more clear that they're walking away? So what should she have done? Probably acted a little more strong, right? Fired her butt. Okay, how about this one? Excuse me here. Gibraltar Coffee Shop has one cash register. Prior to Faith joining the coffee shop, each employee working on a shift would take a customer order, accept payment, and then prepare the order. Faith made an employee on each shift responsible for taking orders and accepting the customer payments. Other employees prepare the orders. Y'all like that? Do you not? What do you think? The correct answer is Faith has made one employee responsible for the cash drawer in accordance with internal control policies. Faith has segregated the duties from the accounting to taking the orders. Good. Next one. Because only one employee uses the cash register, the employee is responsible for counting the cash at the end of the shift and verifying that the cash is in the drawer matches the amount of cash sales recorded by the cash register. Faith expects each cashier to balance the drawer to the penny with an every time, no exception rule. What do you guys think? It's not always going to balance perfect, isn't it? So to put that kind of stringent requirement on an employee is going to kind of cause them to get scared and maybe, I don't know, just doesn't seem realistic. And they sure as heck shouldn't be reconciling everything. It's commendable Faith has given employees responsibilities. However, after the cashiers counted the cash, another employee should remove the cash register tape and compare the amount on the tape with the cash in the drawer. Also, Faith's standard of no mistakes can encourage the cashiers to overcharge a few customers in order to cover any possible shortages. I mean, it just doesn't always work that way, does it, guys? Mistakes they're going to happen because we're human, right? Right? Any questions on those? How about this one, guys? An employee of JHT Holdings, a private trucking company, was responsible for resolving roadway accident claims under $25,000. The employee created fake accident claims and wrote settlement checks of between $5,000 and $25,000 to friends or acquaintances acting as phony victims. One friend recruited subordinates at his place of work to cash some of the checks. Beyond this, the JHT employee also recruited lawyers whom he paid to represent both the trucking company and the fake victims in the bogus accident settlements. When the lawyers cashed the checks, they had allegedly split the money with the corrupt JHT employee. This fraud went undetected for 2 years. Why would it take so long to discover such a fraud? pretty intricate. It's involving a lot of people.
Is it why? He resolves it and writes the checks, or he does the work side of it.
He's doing it all. Guys, I had a client. I kid you not. This is true. I had a client that the husband worked for an oil company, and he was in HR, and he'd hire people. And his wife was a person who would go out and find him people to do the jobs. Fit hand in hand, huh? And every year they'd come in and I would say to her, everything you do just turns to gold. Like, I've never met someone who is so successful like you. You know, I see a lot of people, you know, a lot. I've been doing it 37 years. Some years it's 2,000 people. Some years it's 1,500, you know. And I just kept saying, I've just never seen anyone so successful as you. Then they quit coming to me. And I don't know what happened, but just one day I Googled their name. And they were in prison. What happened was he was with HR, and he would technically get part-time help or short help or something on stuff. And he would use her business as the business to hire this help. And it went on for like 6 years. And the only way it got caught is an auditor was looking at something and realized that name of that business was his address. So they looked into it. And I want to say it was like $3 million that they've been doing that with. Now, how does someone get by with that? Because he had the authority to go and hire, because he was HR. And someone wasn't catching that all of these, obviously he approved the bills too. Do you get what I'm saying? And I think she had 3 different company names, but the problem is it was all the same address, their home address. So she would have been a little smarter to have done some P.O. boxes or something, but can you believe it? And so I hate to say this, but now they're born again and they go around to everywhere and share, how God's healed them. And nothing is wrong with that. It's just like they're using that situation to their advantage again, Sorry. Because believe me, I believe in forgiveness and healing and all that. It kind of made me a little upset that I'll just keep it at that. Okay, so what do we want to say here as to it didn't get discovered well enough because he had a lot of power, huh? And this is a case of 2 or more people acting together, right? This is an example of fraud with significant collusion. Frauds that are perpetrated with multiple parties in different positions of control make detecting fraud more difficult. In this case, the fraud began with an employee responsible for authorizing claim payments. This is a sensitive position because his decisions would initiate payments. However, claims would need to be authorized and verified before payment would be made. Knowing this, the employee made sure each claim had a phony victim. Thus, there was a verifiable story behind each claim. Only by tracking physical evidence of the accident would it be discovered that the claim was fictitious. However, the very nature of the process was to resolve small claims quickly, without a lot of work in them. Corrupt lawyers were brought into the fraud to act as attorneys for the claimants. This gave the claims even more credibility. The lawyers had done legitimate business with the trucking company, so everything appeared normal. This fraud was discovered when the fraudulent employee's bank noticed irregularities in his bank account and notified authorities. As the saying goes, follow the money. As a side note, the corrupt claims administrator fell into this behavior due to gambling problems. You'll learn there's something called a fraud triangle. The fraud triangle has a need. Oh my gosh, this is crazy. I should know the fraud triangle. Opportunity and some type of rationalization. So, for example, the need is a gambling problem or a drug problem or just tight on money. The opportunity is the ability to commit the fraud. Something's open that allows it to occur. And the rationalization is actually the scary part. The rationalization can be like, yeah, I'm not getting paid enough. Or I'll give it back. I'm just going to borrow it. Or they're not going to miss it. Do you get what I'm trying to get at? We have to, in our souls, have some way of rationalizing why we're doing our behavior in order to do it. And the weird thing about fraud is all three have to be present for it to occur. Without one of those pieces, it can't occur. And isn't it amazing how we can justify our behavior? It's just really sad. And I think a lot of people say, I'm going to give it back. I'm going to give it back, but it just gets too big. Make sense? Does anyone have stories they know of? Tell me one.
Well, do you know the Monopoly, the McDonald's Monopoly?
Oh, I heard of that.
The 1991 2001. It was the head of the security team of the third party that was supposed to give the Monopoly scratch-offs. Well, he would take all of the, best winning ones because he was the final sealant and the one meant to deliver it to stores. And this went on for like 10 years, and it ended up with collusion with the mafia, was like starting to become other friends and stuff, because as people would get dirt on him that he was doing this, they would get to wrangle in a lot of other less credulous individuals to be in on this story. And I think the craziest part of the story is that he was eventually caught, I think through his ex-wife giving the reason, or snitching. But the craziest part is that this has basically all been wiped from history because he was imprisoned on September 10th, 2001.
Oh, that's interesting. Right near 9/11.
Day before 9/11 is when he was in prison, and then
it all went away.
It all essentially went away.
What's yours?
I just read it. It's not really fraud, it's just that.
No, tell me.
So I used to work as a loss prevention for Walmart.
Mm-hmm.
I did it in Colorado. And this old lady, we had cameras above the registers, and she was the cashier, and she would take cash. She wouldn't close it all the way at the register. She'd take cash, pocket it, and we finally caught it one day, just looking at over in shorts, because you can see if the register is short, even a dollar. And I went through the old ones, and I could see every day that she worked, there were 20 or $50 gone on that specific day. And I was looking through all the footage, and it was just every day she would do it. And I don't know how we didn't catch it earlier. And the footage only went back about 3 months for the registers, and I only got $1,800 for stealing it. And in Colorado, it's stupid. It's a felony amounts to $2,000, so she didn't get a felony conviction or whatever. But what pissed me off most was she denied it.
Of course she did.
And we've caught a lot of people, and they always deny it. It just pisses me off more when they deny it. It's
I've been watching 48 Hours a lot lately. I don't know why, but it's people are never, very few do people admit it and take ownership and want to make restitution or resolution, whatever their choice. They deny it. And you just want to go, somehow they must get themselves in a place where they can believe they didn't do it. I know I live in Red Wing, and I just saw on the news while I was gone that a Red Wing school district member, the school district is a pretty big thing to be a part of. Do you know what I don't know with you guys, but it's a pretty
a lot of your taxes flow into there.
A lot of taxes. Well, guess what? She just got caught for stealing Target. And they went back, she'd go through the self-checkout, and they went and must have looked at a lot of videotapes. If she consistently did it, she just put things in bags and
where she didn't scan it.
And I think they caught about $600 worth. And, guys, a lot of times these are older women. It's not about pain. It's not about the ability to pay for something. It's about something deeper.
It's like they kind of get like a little thrill sometimes. Mm-hmm. It's weird.
It is. Anyway. Yes.
Back in high school, we did a fundraising. We spoke to a lot about backpacks for basketball team. Team shoes and jumpsuits, and only got jumpsuits backpack. And then we found out at the end of the season that the assistant coach who did fundraising, he took 48% himself. And one of the parents, my teammates, found out about it because the assistant coach who went to buy something to his car at my teammate father's car shop, and spent like $2,950 just in that particular thing to his car. And he was wondering where that because he just had it in cash.
Yeah.
So that's how.
Guys, it's out there. It's prevalent. But the job as businesses is to try to prevent this from happening. Because, guys, as long as we're human, stuff like this happens. Yes.
The ice cream place right by my cabin, I think it was 2 years ago, we found out that the owner and co-owner weren't paying their income taxes and sales tax like 5 years. So then they had to shut down for a summer, and now they're under new ownership. I didn't really get.
You just don't get by with it for long. You could maybe get by with it, but not for long. Okay, guys, let's look at this one. A former chairman, CFO, and controller of Don Kenny, an apparel company that makes sportswear for Pierre Cardin and Victoria Jones, pleaded guilty to financial statement fraud. These managers used false journal entries to record fictitious sales, hid inventory in public warehouses so it could be recorded as sold, and required sales orders to be backdated so that the sale could be moved back to an earlier period. The combined effect of these actions caused $25 million out of $40 million in quarterly sales to be phony. Why might control procedures listed in this chapter be insufficient in stopping this type of fraud? Couldn't it be because he's a senior manager and he can circumvent fraud? He can disregard the control procedures. So this type of fraud can be stopped if there's a strong oversight of senior management, such as an audit committee of the board of directors. Individual whistleblowers in the company can make their concerns known to the independent or internal auditors. Guys, most people with the IRS, do you know what the number one way is they catch tax evasion? Spouses. Excuse me. Ex-spouses. Isn't that interesting? Greed, probably. They get divorced and the wife wants something the husband's not going to get.
How much money there really is there?
Yep. Yeah. So what's the moral of that story?
Don't get married, your wife out.
Moving on. You know, we have this wonderful friend who is also an attorney, and he had a thing he would always say. Two can keep a secret if one's dead. Moving on, bank accounts. A major reason companies use bank accounts are for internal control purposes. Bank accounts reduce the amount of cash on hand. Well, guys, we all use bank accounts in this day and age. But bank accounts provide an independent recording of cash transactions. And we're going to talk about how we go about reconciling bank accounts. So, the summary of all transactions is called a bank statement. It's mailed each month and made available online. The bank statement shows the beginning balances, any additions and subtractions, and the ending balance. How many of you guys have seen a bank statement? Good. I want hands to go up. You need to know that things can go wrong with the bank statement. So it is really nice for you to check that you didn't get something in your account. I got to tell you a true story that just happened to my husband and I. Jim's dad just died on April 14th. So BMO Harris is where his dad banked. Well, BMO must have purchased another bank. And Jim's dad's account, whatever bank they purchased, merged accounts, merged their data together. And someone had the same bank account as Jerry, my husband's dad. So, and we didn't know all this because I was doing taxes and his dad was dying. But in April, like $25,000 got taken out of Jim's dad's bank account for IRS payments, Minnesota payments, blah, blah, blah. Well, Jim finally looked at it in June and it's like, Nancy, because I didn't have access to the account, and Jerry does everything by paper. He's 94. He paid, before he died, he had done his taxes and he writes checks to everybody. It's like, Nancy, this money came out. Do you know it took BMO until September to give us back our money? I'm not kidding. And Jim was livid because they should have said, I'm sorry, or it's not our fault. Your system was messed up. And it wasn't Jerry. They had to go and find and prove it wasn't Jerry. It's like, look at his history. He's never in his entire life taken any money out of his account electronically. What's the moral of that story? Check your bank accounts. Got it? That one was a weird one, seriously. But someone royally screwed up. They are merging accounts. They're merging banks. Do you get what I'm saying? And whatever bank that was brought in had his same bank account number. So he goes and does electronic withdrawals from the IRS in Minnesota, and it comes out of Jerry's account. Needless to say, we're not banking at B&O anymore. And they wouldn't even apologize. Jim's like, the least you could do is give us a $50 gift certificate or pay us interest on the $25,000 for, 3 months. Anyway, a company's checking account balance in the bank records is a liability in the bank's records. The company's account has a credit balance. Think of this, guys. When you have a bank account, think about what a bank does. You go and deposit $100 into their bank. What does the bank do? The bank debits $100 and they credit a liability of $100. Why? Because it's your money, not the bank's. Does that make sense? Because the bank statement is prepared from the bank's point of view, a credit memo entry on the bank statement indicates an increase to the company's account. So when the bank says to you, we credited your account for this amount, no, they're looking at it from their perspective. As you give them money, it's a greater debt. It's a greater liability for the bank. They will debit your cash and they credit your account, that liability they owe you. Make sense? Yes? So when we have a company and we have the bank statement, know that from the bank's perspective, your money in their account is a liability. So it will always show as a credit balance. And when you increase that balance, it will be credited. When you decrease that balance, it will be debited in the bank's books. Decreases in the liability will be service charges, NSF checks, bank errors, EFT payments. Increases in that liability will be deposits, note receivable collections, loan proceeds, interest earned, and bank errors could happen on either way. A bank makes credit entries for bank deposits, as I said, by EFTs. If a bank collects notes receivable for the company, if they receive a loan, proceeds from a loan, interest earned on the company's account, and possibly bank errors. A bank will make a debit entry if there's payments for EFTs, service charges, customer checks that get returned for not sufficient funds, or possibly bank errors. So, the bank statement is the primary control that a company uses for cash. A company uses the bank statement by comparing the company's record of cash transactions to those recorded by the bank. The cash balance shown on the bank statement is going to be different from the company's cash balances. And what we do is we reconcile those differences through a bank reconciliation. So, it's basically an analysis of items and amounts creating the difference. A bank reconciliation gets divided into two sections. The bank statement begins with the cash balance according to the bank statement and ends with the adjusted balance. The company section begins with the cash balance according to the company's records and ends with the adjusted balance, and our adjusted balances should match up. So here you see cash balance according to the bank statement with any additions and subtractions, and we get an adjusted balance. And then we'll do the same with the company. Company's cash balance with additions and subtractions, and we'll get an adjusted balance. And guys, those adjusted balances must equal, because we're going to compare where are we off, and we should balance. So the first thing we're going to do is we're going to enter the cash balance according to the bank. Then we'll add deposits that haven't been put into the bank yet. Then we'll subtract outstanding checks that haven't gone through the bank yet. And then we'll come up with some different things and determine the adjusted balance. Then on the company side, we're going to start with the cash balance. Then we'll add some credit memos that the bank recorded that we don't have yet. And then we'll deduct debit memos that the bank recorded that we don't have in our books yet. And then we'll come up with the difference. And we should balance. So here you see the cash balance according to the bank statement, deposits that haven't hit the bank yet, checks that haven't hit the bank yet, and an adjusted balance. And then on the company side, the cash balance, items that have hit the bank that we don't have yet, in additions and subtractions, and an ending balance. Now, errors can happen too. So if we show that we keyed in a check for $880 when we really keyed it in for $860, that's an error we might have to adjust on our books. So the journal entries for power networking based on the bank reconciliation are shown here. So we need to show, in this case, the bank received a note receivable. So the bank had that information, but we didn't have it. So we're going to need to show a journal entry to show those items that the bank has recorded that we now are aware of. Okay? Guys, in the bank reconciliation process, which of the following would be added to the bank's cash balance in order to reconcile the company's cash balance? No, we may have deposits we need to bring to the bank, but the bank hasn't gotten them yet. Does that make sense? So we'll need to show those. Let's look at this example here, guys. Exercise 716. Identify each of the following reconciling items as an addition to the cash balance, or, according to the bank statement, a deduction from the cash balance according to the bank statement, an addition to the cash balance according to the company's records, or a deduction from the cash balance according to the company's records. A bank service charge of $50. I want y'all to think about this. How will we know there's a bank service charge? Where does it show up? On the bank reconciliation, doesn't it? So the bank shows it. Don't we need to then deduct that from the company's records? Right? Because a service charge is a debit memo, right, from the bank. And so the company needs to show that debit memo. Okay? How about this? A check of a customer returned by the bank to the company because of insufficient funds. Think of this. So a customer wrote us a check. We deposited the check. The bank got it sent back because they didn't have enough money in their account. Who was notified of this? The bank was notified of it. Don't we then need to subtract that money from our books? Yes? Are you getting me? Check for $345 incorrectly recorded by the company as $435. What happened there? Didn't we screw up at the company? We said the check was $435, but when it went through the bank, it was actually shown as $345. Isn't that an error on the company we need to fix on the company side? And wouldn't that be we need to add some money to the company because we showed it to be $435 when in fact it was only $345, a check? Yes? Check for $200 incorrectly charged by the bank as $2,000. That's scary. So it was a check of $200, but the bank charged $2,000. The bank will make their correction, but we don't need to do anything on our end because we weren't wrong. Yes?
So for number 3, would that be like a sign of money laundering? No, they just, and reality is most of these things are happening through software. So it's really difficult, because usually when the check is written, the software just updates. So this is just an error in the accounting department. Okay. Next one, a deposit in transit of $4,250. What does that mean? The company knows that money's getting deposited, but it hasn't hit the bank yet. So don't we need to show that as an increase on the bank side?
outstanding checks of 5,420. Checks that have been written by the company but that haven't gone through the bank yet. Wouldn't that be right? So it would need to show up on the bank side as checks outstanding. And if a note is collected by the bank has that information, but we need to update the company's records to show that we have finally received that note outstanding. Okay. How about these? Oh, I did that again, huh? 50, 520. I think I did the exact same one. Sorry about that, guys. Okay. The following data is accumulated for use in reconciling the bank account of Creative Design Company for August of 2026. We're going to take this information and create a bank reconciliation. Now, no, there's two sides to the bank reconciliation. There's the bank's balance with adjustments, and then there's the company's balance with adjustments. We're going to start each side. For example, do you see here? The cash balance according to the bank is 46.3. We're going to get that information, the cash balance according to the bank, 46.3. Do you see the cash balance according to the company's records of 32,560? We show right here. Make sense? Then we are going to take into account checks outstanding of 28,540. Think about it. The company has written those checks. They've been sent out, but they haven't gone through the bank statement yet. Wouldn't those checks outstanding of 28,540 be subtracted from the bank balance? Wouldn't the deposits outstanding be added to the bank balance? Does that make sense? To come up with the adjusted balance? The company has made deposits or written checks, but the bank hasn't received them yet. So we're going to make those adjustments on the bank side so they match the company's side. What we're going to do on the company side is adjust things that the bank has gotten that we haven't gotten yet. Oh, my button just fell off. Oh, I hate that. So, in other words, we have a bank service charge of $45. The bank knows that, but we don't have it. And then, do you see there was an error in recording a check as $1,800 instead of $180? So that was something that the company did wrong. They incorrectly showed the check was $1,800, not $180. So we need to fix that on the company's books. Does that make sense? Let's look at exercise 719. I want you to look at this 1 minute and see how we can adjust it while I try to find my button. It just fell off. Boy, I hate that. Sorry, guys. Well, I'll look afterwards.
Is it clear?
No, it's gold.
Is that it right there? In front of your left button. It's tiny, but a little more forward.
Thank you. First time I've worn the shirt and the button falls off. Okay, thank you. Now, here's the same exercise. A cash balance according to the company's records of $32,560. Won't we put that on the company side? and then a cash balance according to the bank statement of $46,300. Won't we put that on the bank side? Okay. Then it tells us checks outstanding of $28,540. What do we do with checks outstanding? We subtract that from the bank side. Deposits in transit not recorded by the bank. What do we do with that? We add that to the bank side, right? The company has it, the bank doesn't. A check for $180. Oh, did I just do the same one again? I am sorry. I think I did that same one again. So let me go find this one real quick. Let me go in here. Let me find this. I just want to get it right. 719. Let me pull this up. Okay. So I somehow screwed something up here. I think my 716 was wrong. A check for $200 incorrectly charged by the bank as $2,000. No, I did that one right. So this one, guys, I'm sorry. This is right. This one says a check for $180 in payment of an account was erroneously recorded in the and as a check register for $1,800. So we're going to need to make an adjustment of $1,620, right? On the books where the other one was right. So in this example, you'll see that let me get it. That the correct I can't do it that way. The correct bank statement is going to show oh, I know where it is. On 719, maybe I didn't have to do a bank statement. I thought I did. Prepare a bank reconciliation on 719. If the balance sheet were prepared for creative design on August 31st, what amount should be reported for cash? Must a bank reconciliation always balance or reconcile? It always needs to balance or reconcile, doesn't it? 718, 719. Okay, the bank reconciliation is right here. The cash balance is per the bank. The cash balance per the company records we show. We show our deposits and transits. We subtract our checks that have not cashed yet. We need to fix the error. We said the check was for $1,800. It really should have been for $180. Do you see how we add that back? And the service charge, the bank charge that we don't show yet, we need to subtract from our books, don't we? Does that make sense? Yes, no? Okay. So the 2 journal entries we need to show in our books are items that we did to our company's records. Not the bank, but the company's records we need to adjust for. So do you see that since we had that check incorrect, we had it as $1,800 instead of $180. Do you see how we need to correct that on our books and add our cash, reduce our liability because it's only $180, it's not $1,800? And likewise, do you see how we need to show that bank service charge of $45? The company reported it, but we have yet to report it, so we need to show that adjustment in our books. Anything we do to the company side of the bank reconciliation needs to be reported in our books in the financial statements. Okay? Now, let's see what else we've got. Exercise 720. Accompanying a bank statement is a credit memo for $21,200 representing the principal and interest on a note that's been collected by the bank. The company has been notified by the bank at the time of the collection, but had made no entries. Journalize the entry that should be made by a company to bring the accounting records up to date. So think about this, guys. On our books, we have a debit to an account receivable. The bank collected it. So now we need to show that account receivable has been received. So we will credit the note receivable of $20,000. We will credit our interest revenue of $1,200 and we'll debit cash for the full amount. Okay? Make sense? An accounting clerk for Chestnut Company prepared the following bank reconciliation. From the data in this bank reconciliation, prepare a new bank reconciliation for Chestnut Company using the format that we're supposed to use. If a balance sheet were prepared, what amount would be reported for cash? Okay, first of all, we know that we're supposed to, on a bank reconciliation, start with the bank's balance. The bank's balance is $27,645. Isn't that the first thing we do? And then we record outstanding deposits. We subtract outstanding checks. So over here, you see outstanding deposits, and we see outstanding checks. So we add our outstanding deposits, we subtract our outstanding checks to come up with an adjusted balance. Next, we show our cash balance according to the company. We show any errors, and we show any notes or any changes the bank did that we have not yet done. So in this case, the bank, we see that the true check was $785 and we recorded it as $875, so we need to fix that. And we received a note from the bank that we need to report, and we need to subtract our service charges. Okay, so do you see our adjusted balances of $34,165 total? Aren't we good there? So another one is the same. We start with the bank balance. We here is one that was done, but guys, look what they did wrong. The bank balance, we start with the balance. We add outstanding deposits and we subtract outstanding checks. Do you see they did the opposite? They added outstanding checks and subtracted the outstanding deposits. Isn't that wrong? We add our deposits to the bank statement. We subtract our checks. So that's the first thing they did wrong there, is they should add deposits, subtract checks to come up with the figure. For the company, service charges should be subtracted, right? Correct? And I'm trying to think what else they did wrong here. Service charges should be subtracted. The error in the June 17th deposit of $7,150 was shown as $1,750. So that was a big oops that we need to adjust that deposit for. Okay? So as you see here, if you follow the add deposits outstanding, subtract checks outstanding, for the company's balance, we add notes receivable. We screwed up on a deposit. We said it was $1,750 when it was $7,150. We adjust that. And since we had an NSF returned, we have to adjust that along with our service charges. Okay? Let's see, where are we standing? There are sometimes where company has to pay small bills, small amounts. And often companies set up what's called a petty cash fund to make these small payments. A petty cash fund is established by estimating the amount of payments that might be needed during a week or a month, and we keep a separate box, cash box, for that. Assume a petty cash fund of $500 is established on August 1st. We would create this petty cash fund by debiting our petty cash and crediting cash to just show we've got a petty cash fund in there of $500. We have different uses of that $500 on hand. As you can see, we had receipts to show we purchased office supplies of $380. We have postage of $22, store supplies of $35, miscellaneous admin expenses of $30, which totaled our $467. So at the end of the week or the month, to replenish this petty cash, we're going to record these adjustments or these transactions and receive more cash. So as you see here, we debit all of our supplies and expenses. We credit our cash because we use that up. And then we'll replenish our petty cash with an extra $470. No, cash is a current asset. It's the first thing. It's the most liquid of all because it is cash. Companies normally invest in liquid investments so they can earn interest. Know that cash we record as checking accounts, currency, dollar bills, but sometimes companies want to make interest on their money, and we record that into probably a money market account. We use the term cash and cash equivalents synonymously, meaning cash is available for hand right away, but our cash equivalents, such as money markets, are also able to be converted to cash right away. No, oftentimes there will be notes to the financial statements explaining what is the term cash equivalent used for. Days cash on hand. So basically what we're looking at are various ratios here. The higher number of days that cash is on hand, shows that cash is more liquid and you're able to use it up, or you've got it available to help pay your bills. I'm not going to worry. Petty cash fund entries. Let's look at this. Journalize the entries to record the following. Check number 12-375 is issued to establish a petty cash fund of $500. And then it says the amount of petty cash in the petty cash fund is now 0. Check number 12-476 is issued to replenish the fund based on office supplies of $212, miscellaneous selling expenses of $156, miscellaneous administrative expenses of $61. And then because the amount of the check to replenish the fund plus the balance in the fund don't equal $500, record the discrepancy. So here you'll see, let me show you, 724. What we'll do in order to initially create that petty cash is we debit our petty cash for $500, we credit our cash. Throughout, we used office supplies, selling expenses, and administrative. But we're missing $31 here, aren't we? So since we're missing the $31, bless you, we'll show that as a short and under and credit our cash of $460. So the key, guys, for this week is understanding internal controls, knowing how to complete a bank reconciliation, and then knowing how to show journal entries for bank reconciliations and for petty cash. Does anyone have any questions at all? How are you doing? Yes.
For the petty cash account, could that be put on like a credit card?
I'm sorry, can it be?
Could that be used as like a company credit card, or is that just like a separate?
It's a separate cash. It's literally cash in a box. Okay? Company credit cards can be used also for various departments, but this here is really cash that people use to pay for miscellaneous items.